Hey there, future homeowners. Welcome back to Polished Perfections. Are you ready to take the exciting leap into buying your first home? Today, we've got you covered with essential tips to ensure a smooth and successful journey into homeownership. Let's dive in. First things first, establish your budget. Before you start browsing listings, take a close look at your finances to determine how much you can comfortably afford. Factor in your income, existing debts, down payment, and closing costs. Being clear on your budget will help narrow down your search and prevent you from falling in love with a home that's beyond your means. Here is a calculated example of a debt-to-income ratio. This will give you an idea of what you can afford. This is also the calculation that lenders use to evaluate risk. Let's do the numbers. Say you have a gross monthly income of $5,000 and your monthly obligations are: rent, $1,200. Car loan, $300. Student loan, $200. Minimum credit card payment, $100. For a total monthly debt of $1,800. To calculate your debt-to-income ratio, you divide your total monthly debt payments by your gross monthly income and then multiply by 100 to express it as a percentage. Total monthly debt payments divided by gross monthly income then times 100. Using the numbers from our example, $1,800 divided by $5,000 times 100 equals 0.36 times 100, giving you a DTI ratio of 36%. In this example, your debt-to-income ratio is 36%. This means that 36% of your gross monthly income goes toward debt payments. Lenders often use this ratio to assess your ability to manage additional debt, such as a mortgage payment, and typically prefer borrowers with lower DTI ratios, generally below 43% for most mortgage programs. Note: lenders will probably calculate rent into a potential mortgage payment. In this example, your rent is $1,000. If your potential monthly mortgage payment is $2,000, that would take you over the debt-to-income ratio percentage over 43%, and you may not get approved for that reason.
Now let's go in depth on what goes on behind the scenes when applying for a mortgage loan. Today, we're demystifying the process by delving into what lenders scrutinize to determine your eligibility. Let's unravel the mystery. First and foremost, lenders assess your credit score. This three-digit number reflects your creditworthiness and financial history. A higher credit score signals to lenders that you're a reliable borrower, increasing your chances of approval. Aim for a score of 620 or higher for conventional loans, although certain programs may accept lower scores. Income and employment stability are also paramount. Lenders want assurance that you have a steady source of income to repay the loan. They'll examine your employment history, looking for consistent income over time. Be prepared to provide pay stubs, W-2 forms, or tax returns to verify your income. Your down payment size plays a significant role in mortgage approval. While conventional wisdom suggests a 20% down payment, many lenders accept lower amounts, sometimes as low as 3% for certain loan programs. However, a larger down payment can improve your chances of approval and may help you secure better loan terms. Some lenders will also consider your assets and reserves. Beyond the down payment, they want to ensure you have enough savings to cover closing costs, property taxes, insurance, and other expenses. Having reserves demonstrates financial stability and preparedness for homeownership. Finally, lenders evaluate the property itself. They'll conduct an appraisal to determine its value and ensure it meets lending standards. Factors like location, condition, and type of property can influence the appraisal and ultimately, your loan approval. Now that is all out of the way, let's get pre-approved for a mortgage. This is a crucial step because it gives you a realistic idea of how much you can borrow from lenders. Having a pre-approval letter in hand shows sellers that you're a serious buyer and can give you an edge in competitive markets. Now, let's say you have been pre-approved for $300,000. After being approved, you should make a list of your must-haves and nice-to-haves in a home. Consider factors like location, size, layout, amenities, future resale value, and most of all, cost. Remember, compromise may be necessary, so prioritize what matters most to you. It's also essential to research neighborhoods thoroughly. Take the time to explore potential areas, considering factors like safety, schools, proximity to amenities, and property values. Don't hesitate to reach out to locals or real estate agents for insights into different neighborhoods. When you found a home you love, don't skip the home inspection. Hiring a qualified inspector can uncover any hidden issues with the property, potentially saving you from costly repairs down the line. Use the inspection report to negotiate repairs or price adjustments with the seller. Lastly, surround yourself with a reliable team of professionals. A reputable real estate agent, mortgage lender, and attorney can guide you through the home buying process, answer your questions, and advocate for your best interests. Note: an attorney is not necessary if you have a reputable real estate agent and mortgage lender.
Now let's review the different types of mortgage loans available to homebuyers. Each one will have its own features, benefits, and eligibility requirements. Here are some of the most common types. 1. Conventional. These are traditional mortgage loans not insured or guaranteed by the government. They typically require a down payment of at least 3% to 20% of the home's purchase price and have fixed or adjustable interest rates. 2. FHA, short for Federal Housing Administration. Insured by the Federal Housing Administration, these loans are popular among first-time homebuyers and those with lower credit scores. They require a minimum down payment of 3.5% and have more lenient qualification criteria compared to conventional loans. 3. VA, short for Veterans Affairs, guaranteed by the Department of Veterans Affairs. These loans are available to eligible veterans, active duty service members, and their spouses. VA loans offer competitive interest rates, no down payment requirement in most cases, and no PMI, short for Private Mortgage Insurance. 4. USDA, short for U.S. Department of Agriculture. Backed by the U.S. Department of Agriculture, these loans are designed to help low to moderate income borrowers purchase homes in eligible rural and suburban areas. They offer low or no down payment options and competitive interest rates. 5. Jumbo loans. These loans exceed the conforming loan limits set by Fannie Mae and Freddie Mac, making them suitable for high-priced properties. Jumbo loans typically require larger down payments and have stricter credit and income requirements. 6. Fixed-rate mortgages. With a fixed-rate mortgage, the interest rate remains constant throughout the loan term, providing predictable monthly payments. These loans are available in various terms, such as 15, 20, or 30 years. 7. ARM, short for adjustable rate mortgages. ARMs have an initial fixed interest rate for a specified period, after which the rate adjusts periodically based on market conditions. They often start with lower initial rates but can fluctuate over time, potentially increasing the borrower's monthly payments. 8. Interest-only mortgages. With an interest-only mortgage, borrowers pay only the interest for a certain period, typically 5 to 10 years, before transitioning to principal and interest payments. These loans may be suitable for borrowers who expect their income to increase in the future. 9. Reverse mortgages. Designed for homeowners aged 62 and older, reverse mortgages allow borrowers to convert part of their home equity into cash without selling their home. The loan is repaid when the borrower moves out of the home or passes away. Each type of mortgage loan has its advantages and considerations, so it's essential to carefully evaluate your financial situation and goals before choosing the one that best fits your needs. And there you have it. By understanding what lenders look for, you can prepare a strong mortgage application and increase your chances of approval. Focus on maintaining a healthy credit score, stable income, manageable debt-to-income ratio, sufficient down payment, and solid assets. With these key elements in place, you'll be one step closer to securing your dream home. Please leave comments and questions below and I will respond. Don't forget to smash that like button, give a thumbs up, and subscribe for more content.